Okay, Tina, do you think we should begin and just have him come in?
So it's scheduled. I saw that the Twitter feed said it was live at 12:05. So if that's indeed the case, then we can wait. He's the moderator, right?
Correct. Yeah. So
Well, if he doesn't join, then I'm gonna have to do a little dance with the panel, which is fine. But maybe let's give him until 3 past.
Sure, that sounds good.
Okay.
I see that Tyler's on from Copper. He's entering the room now, so hopefully.
Oh my gosh, can you hear my dog? I don't know what to do with her.
I can't hear you.
You can't? Okay, good.
I can hear her growling. I thought I had something on the background. I'm like, is there something? Do I have a website open?
No, she's snoring. She's not growling. She's just having a snoozle. And if I put her in the other room, she'll just want to come in here and be more disruptive. Oh God, I'm gonna have to wake her up. Pop. Also, is what I see on the screen what the audience sees?
Yes, it is.
Okay, thanks.
All right.
Okay, now I see a split screen with, it's wonky. Okay. So does Tyler have the presenter link?
Yes.
Yeah, I just sent it to him one more time. He said that he's having some sort of technical difficulty using it, but we know it works because everybody else is here. So I don't.
Okay. Maybe we just start introductory remarks.
Okay,
Hold
I'll
this
go
too
slow.
long. Okay.
Poppy. Shh. Hello and welcome everyone to another great panel live program brought to you by the Chamber of Digital Commerce and our friends today at Copper. I'm Tina Baker-Taylor, the Chief Policy Officer at the Chamber, and I'm delighted to be your host for today's event. We'll be focusing on one of the most important issues facing our industry today, custody. Whether you're a financial institution, a retail investor, or a company that is considering holding digital assets, a big part of your strategy has to include how to custody your investments. Security is a top priority, as are transaction reports, compliance requirements, tax reporting, and settlement speeds. Custodians are critical to the widespread adoption of digital assets, and increasing interest in these products from both retail and institutional investors has inspired growth of custody options. Today, we're joined by some of the leading innovators and providers of custody solutions for a fascinating look at where the industry is now, what challenges we still face, and where we're headed in the coming years. We welcome you to jump in to participate at any time in the conversation. Please use the chat function, which you'll find located at the bottom of your screen, to submit any questions that you may have for the panel, and we'll do our very best to answer them. So with that, let's get started with our first panel. It's my pleasure to welcome Brian Rooney, Head of Enterprise Sales at Copper, Alan Kavensky, Interim CEO and Chief Legal Counsel at tZero, Nadine Tisheni, Director and Global Lead for Digital Assets and DLT at Citi, and Sven Werner, Global Product Manager at State Street Digital. Over to you, Brian. Oh, I think we might have Brian might just be a moment. So the panelists, welcome, and we'll just give Brian a couple minutes to join. Perhaps we could each just take a moment, and I like to ask people to kind of give your 30-second kind of Twitter handle introduction to yourself. Let's start with you, Sven.
Yeah, thank you. My pleasure. So my name is Sven Werner. I work for State Street, more concretely in our new product division called State Street Digital, that brings together our activities around CBDC, crypto, of course, but also tokenized securities and the whole servicing around that and within that area. Product manager, so I'm looking at our initiatives, particularly around digital cash and custody.
Brilliant. Thanks for that. Alan, welcome. Please tell us about yourself.
Terrific, Nina. Thank you for having us, and thank you for inviting me to another terrific event hosted by the Chamber. I'm Alan Konevsky. I'm the interim CEO and Chief Legal Officer at tZero. I've been with tZero for about 3 years. I came to tZero with a 20-year background at MasterCard, Goldman Sachs, and Sullivan & Cromwell. tZero, of course, is driven by its mission to democratize access to private capital markets and establish a more efficient, accessible, and transparent Wall Street through blockchain technology. We are aggressively driving to achieve that mission by offering a technology platform that brings together issuers and financial firms seeking a transparent, automated, digitally enabled marketplace, and investors who are seeking seamless one-touch access to unique private assets, public equities, cryptocurrencies, and other digital assets, including NFTs.
Brilliant. Thanks very much. Welcome, Alan. Nadine, great to see you again. Tell us a little bit about you and what you do at Citi.
Hi, thank you for having me on the panel. Nadine Tisheni, I am the Digital Asset Lead globally for Citi's Security Services business. So I think with that, we look at digital assets across the whole spectrum of both public, private blockchains, CBDCs, tokenization. We're working on multiple projects around the globe. We really do see digital assets has accelerated dramatically in the last few years, and it's clearly going to be part of the future. So, with that, we have a specific focus. We've been working on DLT and digital assets for quite a number of years, and looking at how, as a securities services business, we can service our clients with these new asset types in addition to our traditional services.
Brilliant. Nadine, that's a perfect segue to my first question for the panel. So if we're looking at digital assets, this emerging asset class, and the role that traditional custodians have played, what is the role for the traditional custodians today in the safekeeping of digital assets? So, we've come on this journey. We now have, a significant amount of institutional investors entering the space, and we've seen, a number of the custodial incumbents either looking to enter or actually entering the space in a material way. Sven, let's start with you again. What's the role of the traditional custodian, and how are you at State Street looking at filling that gap in the digital asset space?
Yeah, I think that's an excellent question. So thank you for that. Really, the starting point is we have to straddle both. So most of the organizations and clients we are working with will have an existing portfolio of traditional assets, and they starting to add various forms of digital assets into their portfolios. And so you have to, as a starting point, do what you continue to do today, and you have to link it into that digital world and to have a seamless bridge between both. And that in itself is a challenge, because obviously you need to continue to invest and maintain the old and the new and make sure that they work seamlessly together. The other key aspect is around custody, if you want, in the traditional asset management industry, is as much as an operational as it is a legal and control construct. So there are a number of services typically we would have to perform around pre and post-trade controls, making sure, for instance, that the investments and operations are done within the investment guidelines of a fund. And some of these concepts don't translate easily into a digital world, because today custody really is based on a premise that there is a centralized market infrastructure. There's a natural home market for certain types of assets. There's clear business days, there's a convention when you settle, etc. And none of that really exists in crypto and has to be developed. And the third area really is to think about the needs of clients, particularly when we are looking to see more institutional flow coming into that space. And institutional flow really, for me, doesn't mean just like an individual investing more, but the kind of investment patterns that you need to see, where you have to decouple, if you want, your transaction and trading decision from the counterparty risk. And that is something I think that the custodian, the digital custodian of the future, will have to develop an ability to make sure that we move away from that pre-funding concept that if you want to trade on a certain crypto exchange, you have to place your assets there and therefore take a counterparty risk, and have the experience from the traditional market in terms of you have a custodian where the assets are safe kept and you can tap into liquidity across all these platforms. So that's really where I would see our value going forward.
Fantastic. And Nadine, I was just going to ask you, where have you seen the demand coming from? So we've seen some announcements from Citi around, offering digital assets specifically to private banking in the last couple of weeks. Where do you see the demand coming from?
Well, I think like most of the custodians in the industry, we're starting to see a real increase in inquiries from institutional investors, from other banks, from other brokers. And I think that's really just reflective of what we've seen over the last couple of years around crypto. The tone of the conversation's changed quite a bit since 2017, where it's what is DLT and crypto to we're looking at the feasibility of moving into the space and investing. How do we do that? So I do think we're seeing across the board, and the early demand was more hedge funds, high net worth, family office, but I think that's expanded quite a bit to traditional institutional investors. Just the way we look at it as a custodian, we not only look at public blockchains, but we also look at private permission blockchains as well, and digital assets on those. So we're starting to see projects around the world across our direct custody business, financial market infrastructures, developing digital asset marketplaces. So when we look at the value that potentially a traditional custodian can bring, like Sven said, we can custody both traditional assets alongside digital assets. I think we're going to see a lot of increase in fragmentation in terms of our clients wanting to invest in multiple different markets, asset types, public, private, digital assets. There'll be CBDCs, stable coins. And I think the custodian can provide that connectivity into multiple marketplaces and harmonize that for clients so that they can then focus on the investing. So not only that is providing the balance sheet and the credit behind it, as Sven mentioned, because most of it's pre-funded at the moment. But I think in the next 5 to 10 years, we'll see increasing fragmentation, and clients will want to see their custodian be able to custody both traditional and new digital asset types. And I think even the breadth of types of assets that we'd be custodying will broaden. So, looking at private market assets, an example, other tokenized assets like real estate. So I do think these are areas in terms of harmonizing fragmentation, providing the credit and the balance sheet, providing a single operating model for clients, as well as just being able to safeguard the assets is quite important in what custodians can bring.
Tina, hi there. It's Brian from
Hi,
Copper.
Brian,
I really
welcome.
apologize, everyone. I got myself in a loop. I'm here. I'm sorry. Everyone, I'm assume, has been introduced to our wonderful panelists. I can only apologize wholeheartedly. Look, I've just got a couple of questions. I think, Nadine, you raised a fantastic point there, just the demand that's coming. Regulation is going to be an interesting, interesting conversation, certainly around traditional asset managers, traditional custodians' ability to hold crypto. How do you see regulation essentially affecting the landscape if you, as a custodian today, can't actually, because of the regulations, hold crypto or provide custodial services by having crypto in-house?
If you want,
question, I guess, to Sven and Nadine.
If you don't mind, I'll make a start, Nadine, and then hopefully you can contradict me where I'm wrong. I would say there's no single answer. So there are a number of jurisdictions that have actually made the provisioning of crypto custody a banking service and subject to a licensing regime. And if you take Europe, for instance, MiCA is very clear. In 2 years' time, everyone who's a bank today will be able to do crypto custody. It wouldn't even need a new license, subject to being able to fulfill a number of operational risk, legal governance requirements that come along with providing that service. That's the one side of the story. The other side of the story is you have the Basel Prudential proposals around the capital charge for holding crypto exposure, which is quite punitive. So that may disincentivize going too far into that space. And the other question is obviously the safety and soundness of banks. And that would typically be a question of where are you located and what is your lead supervisor. And at the moment, I don't think there is a single answer to say what you can do in one jurisdiction isn't necessarily the same in another jurisdiction. And that even is true amongst the G20 countries. So I think it's a bit of a novel situation that the level of global consistency, I think, is lacking in that area.
Yeah, I would agree. You really have to look at it on a jurisdiction by jurisdiction basis. But if you look at what custody means under the US regulation from the OCC, I mean, custodians have been custodying various asset types. And there's nothing really in the regulation there that specifically states that custodians can't custody private keys for crypto assets. Now, the question is in the detail and what it means to custody crypto assets. Is that control of the private keys, and what safety and soundness actually means? So I do think there's a long way to go. And that's dialogue with the regulators, but and getting down into the detail of what that security and soundness actually means. So if we look at that from the US perspective, but as Sven mentioned, certainly in Europe, they are starting to formulate clearer regulation, and I think that will only help create a better environment and a clearer environment for custodians and investors alike.
Can I just say one thing, which I so agree, Nadine, what you're saying? There's very rarely we have seen a situation where regulators says explicitly it is not allowed. It is this level of we have to prove that this is a good idea if you can comply with safety and soundness expectation. That makes it, unfortunately, I think, a bit more difficult to say, can you actually go ahead or not in that level of uncertainty.
So just to follow on from that, so where we are today, and I take your point, Nadine, you're absolutely right. Regulations, jurisdictions, they're different. The US tends to be one of the leading lights in terms of regulators, and the rest of the markets tend to follow. Understanding where they currently are, does that mean we'll probably see initially a little bit more of a sub-custody model to support this?
Yes, I would think so. I think there'll be certainly important to look at it on a jurisdiction by jurisdiction basis and the appropriate licensing in each of those jurisdictions.
And Brian, let me weigh in for a second. I think I agree with you, and it's not only driven kind of top down by regulatory considerations or lack of clarity or hesitancy on part of larger players to dive into this the space where there is lack of clarity. It's also driven by market participants who have some reluctance to engage with a traditional custodian because of a bias of them not necessarily being as nimble and as digital friendly and as forward thinking as some of the new entrants who have been playing in the space, including in the United States, and managed to secure whether federal or state charters that enable them to provide crypto custody services. By the way, we're talking about a lot about crypto.
Mm-hmm.
You got to acknowledge digital asset securities as well, and that's a more nascent field. Crypto has moved faster than blockchain penetration in the security space, certainly in the public markets. Although in the public markets, particularly tZERO have been innovating with blockchain for some time, and there's guidance from the SEC towards the end of last year that kind of provides two custody models, including user-directed self-custody with a bank, so a traditional custodian, whether someone who's sort of crypto forward-thinking or someone else, as well as custody by a special purpose broker dealer. So that's this new entity that doesn't really exist yet, is subject to SEC and FINRA approval, and still leaves a number of unanswered questions like, what is the special purpose broker dealer going to do with private keys at the end of the day to its wallet addresses? Should it use a key management service provided by a vendor, effectively a custodian, or something else? So kind of a whole host of custody questions is, and what the custody model is going to look like in the digital asset security space as a successor to the traditional DTCC custody and clearing firm custody model. And a lot of the questions are very similar to what's happening with crypto as well.
Absolutely. Look, I've got another question. Look, I apologize if it's repeating some of the ground you guys have already covered. It is really quite an interesting topic, certainly for the custodian. In terms of their role now, obviously you've got a traditional role of being a safekeeping of assets. What is the future role and understanding the future role of safekeeping apps, and obviously for digital? And is really for the traditional, let's say State Street, let's take Citi, for example, is it purely brand extension so that you're offering, because we see new asset classes coming in? Is it because it's being client demand driven? Is it traditional providers? Are you seeing more institutional interest? And that's essentially what's piquing the interest of essentially institutional custodians and your ability to provide these services. Like all of these things, a lot of it is demand driven. So it's trying to understand, where are you seeing the demand coming from that's actually essentially bringing you guys to the table? Sven?
So we see demand coming from multiple areas, and over time, there's obviously a shift. So it really started in what we call the asset owner space, particularly in the US, endowment fund, these kind of organizations, and starting to make their way into sort of the smaller hedge funds and alternative funds. I think for really regulated funds in Europe, like UCITS or 40 Act fund in the US, that as you know, there's subject to a number of regulatory decisions that the US and the European regulators still have to make. What I find most interesting is also that there's a bit of a shift in also how these type of organizations are looking to invest in those markets. When we're looking back 2-3 years back, it was really a question, I have some Bitcoin, can you hold them and maintain it? That's it. Now people looking at more complex portfolios with going down the curve, if you want, around a number of coins, also doing long short strategies, baskets, dynamic adjustments. And that creates a level of complexity that we just at the beginning of our panel, we talked about some of the regulatory challenges. As you're building for something, you have a model, and by the time you're there, the market has moved and you need to add more. So I think that is really what sets this area apart, maybe from the digital market. The pace of change to how we to which we have to respond to is probably much faster than we're used to in the traditional space.
So, just in following on from that, I probably pose this to Nadine. So, what you talked about essentially, we are seeing, and do you see the traditional prime broking model now applying essentially to digital, where essentially banks could put their balance sheet out for essentially leverage to these types of funds, for you to essentially be the custodian for the supply? So you start to see long short funds coming in to start shorting the crypto market. Do you see that sort of activity, and do you see the space evolving into that?
I think we're already seeing that evolve into that with some of the traditional, the specialist crypto custodians.
Yes.
So if you look at their models, I think if you look at traditional custodians or banks, because prime business is quite separated from the custody business, I think it will be an evolution, but I think the industry is further away from that. I think the first steps are, can the traditional custodians, if we're talking about public markets, specifically crypto, can they enter this space in a safe, sound, regulated way and ensure the safety of those assets? So I think the industry as a whole is probably still at that point, and maybe a little bit further away from the prime model and the trading model, though I wouldn't underestimate the speed at which that could occur. But I think there's definitely further steps along the way, and certainly the regulation needs to support that as well.
Yeah, great, thank you. So on that, you've mentioned, which I think is, it's essentially getting your first steps right, so to speak. Let's not run before we can walk. And I agree with you, getting the custody model right, having something that goes to market that gives people confidence. So on that, I mean, what are the traditional custodians doing to mitigate settlement risk and exchange risk in this market? And I'll ask that to you. I'll actually, Sven, if you want to have a first go at that, and potentially Nadine, you've got thoughts as well.
Yes. So I think there are solutions now being developed, particularly from a technical perspective, that I sometimes dare to call this, not dare to call this like a clearinghouse functionality, but something of that nature that allows you to present assets to various exchanges and only move them at the point of trades. I think that's a market we have to develop, and that obviously has a certain level of risk-taking functionality, whether you call it prime or clearing or whatever you have. I think that's key to be developed also from a custodian perspective. If you think about the value proposition, ultimately, if we can't solve for this, you can build the safest Fort Knox solution as a crypto custodian, but you would have to ask your client, as soon as they want to liquidate their assets, to move them out of your safety zone and into the open market. And I think that can work if what I said earlier, back to these buy and hold strategies, where you have very few trading situations. But I think it's not a scalable model for the type of organizations we would support. So I think that's the area where we're looking at what is feasible. Also, I would think this ultimately it will be a requirement for a number of regulated funds who obviously will have to disclose the risk taking of their providers, and it would be almost like very complex to explain to clients a situation where they're saying, here's a custodian, here's my due diligence process, but by the way, when I trade, none of this applies. I think even from a transparency perspective, it will be important to resolve that issue.
And Nadine, do you have thoughts on that?
I would agree with everything that Sven said. I think we will see those models develop, and I think it's pretty critical. So we're already seeing, that in the market currently with certain providers, but to ensure that the assets remain safe, we really want to see a separation of, like we have in the equities market, a separation of trading and custody. So I think that will only help the development of the industry, and I think we will see that occur, and it also increase the safety in terms of the custodians being able to maintain those assets in cold storage without having to actually touch the blockchain and move those into an exchange, and those assets being then some counterparty exposure with the exchange. So I do think that's a critical step, and it will need that sort of network effect.
Brilliant. And do you see that the biggest risk at the moment, obviously, the exchange risk, pre-funding the exchange? You see that as the largest, certainly in the transactional side. Is it just the exchange itself on the counterparty? Do you see that that's where most of the risk exists? I'll ask that to Alan. Have you got a thought on that?
Yeah, look, I think certainly as you've seen the crypto market evolve from its early days of the kind of intellectual purism and blockchain maximalism to accept a very, very meaningful degree of centralization, with large exchanges playing very meaningful roles. It differs from geography to geography. That's generally the case, including in the United States. That's a key area to watch for. Look, by the way, as you think about the journey here and you move towards this kind of the beauty, as Commissioner Peirce called it, of self-regulating digitally native representations of value sitting on a signal technology layer with minimal intermediation, I think the custody function is going to be the last one to go. But you are going to see kind of the journey, which is driven by regulation of, from the beginning and the purism to centralization, which you see now. And there's a lot of regulatory conversation about how centralized DeFi is, at least from a perspective of the SEC Chairman Gensler, for example, and the perspective on risk of those centralized exchanges and other participants and how that should be managed and regulated. But that will hopefully, as the technology journey continues and more confidence is built into the technology layer itself, you'll see a move away from centralization. But for the time being, that is the key area for the custodians to focus on. But I think as you move past that, the custody function is probably going to be the last one to be around, I think, or at least some sort of a key management service by outside services, which is effectively what we mean by custody here. So.
I mean, look, it's come up a lot, and we have mentioned it. I mean, regulation is the driver here, and I think a lot of our industry, look, having come from traditional banking myself, it is a heavily regulated market for obvious reasons. And look, regulation in this sense is a good thing. I mean, obviously, but if it's done well, and obviously if it's thoughtful. I mean, Nadine, do you think the regulation's too slow? Do you think it's coming at the right space? Do you think with the right level of regulation, we'll see more adoption into the digital space?
Well, yeah, I think clearer regulation is certainly needed to bring in the traditional investors, custodians. So I don't want to comment on whether that's been too fast or too slow. I know that all the regulators are looking at it. I think that even in terms of Citi, we're being thoughtful about what we pursue and how we pursue that, and looking at the risks and what the regulatory clarity is. I do think, though it's needed, and I think we're seeing good progress in Europe, and I hope that we see that in other markets, but also some consistency in that regulation as well globally, I think is needed, because we certainly don't want to see jurisdictions taking really dramatically different approaches.
I agree. And Sven, what about your thoughts there?
I fully share the notion that the regulation will help, but I would also say there's in many ways, we're also always advocating for, if you want, technology neutral regulation. So you don't want all the little technical details enshrined in law, because then you lose the ability to change if innovation happens. So in a way, regulation can help to create a baseline, but it doesn't take away the need for the industry to agree on certain best practices that then can be reinforced by regulation. So some of the areas in crypto, when it comes to transaction processing, so you have no matching process in that sense. So you need to make sure that when you whitelist addresses, that you have some ways to securely exchange that information. And for that, this is also very important for me, that the crypto custody here is not just, do I have a safe and secure way to store a key or use a key, but also all the rest, the entire instruction process, transaction management process, the identification of your clients, the verification, whether they're authorized to instruct certain movements. That whole process also requires an infrastructure. And in many ways, regulation will then just say, well, you need to adopt a safe and secure method to ensure that, for instance, you make sure that there's no fraud in that process. But then it still comes back to us as market participants to come up with real solutions how that has to happen. And so therefore, I think both has to happen at the same time. I don't think we can wait for regulators to tell us those technical details. We as an industry have to develop them and then make sure that there's buy-in and support from regulators when they review those solutions.
Yeah,
so now I think you mentioned before, you had some comments around the DeFi stuff and the regulation. How do you view regulation then supporting where you're going across on the staking side? We've got funding, DeFi, that type of stuff. Is there clear direction? Are we getting clear direction from the regulators in support of those kind of activities?
Yeah, look, I think, Brian, you're baiting me to step into the recent developments with folks like Coinbase, and I'll take that bait diplomatically. I think it's part of an ongoing conversation, and Sven touched on it elegantly, is how much regulation is enough, how much is too much, how much should be principles based, how much should be granular, especially considering that what's granular today is obsolete tomorrow in this space. And so we and others in the industry have been having a conversation for some time about the need for more clarity around the definition of a security, which is at the core of what's going on at the end of the day. In particular, the interpretation of federal securities laws by a U.S. Supreme Court case from 1946. We still believe that to be the case. You're asking folks to make business decisions, to make capital allocation decisions, to develop products in an environment of uncertainty with risk of hindsight enforcement action that can happen weeks or years later. And there are examples on either side of that, often years later. And that's not necessarily an environment that can encourage innovation and optimal allocation of capital. And so, but we as an industry, and Sven touched on that, also have to be more proactive in helping the regulators to think about precise use cases, precise products, precise consumer applications, and less conversations about philosophy. And look, I'll make one other observation about the global impact of this. And SEC Chairman Gensler made that comment a day or so ago. I think with folks from the European Parliament, if I'm right. This is a global. Look, there have been conversations about global harmonization and global regulatory regimes and convergence and all this stuff. More often than not, it doesn't work out, and financial services continues to be largely balkanized. I'll set aside the EU, but I think crypto, more than anything, particularly given the global vision of digitally native intranet of money, needs global coordination, and so that's going to be a very tricky thing to keep an eye on.
Wonderful. I did see a prompt up there. I'm not sure how we're doing for time, but Tina, Deanna, sorry, I should say, do we have time for one more question, or should we pass back to you?
If you have a very short closing question, again, kind of Twitter style, 240 characters or less.
So really, look, I think it's a question. Is traditional finance, traditional custodians, are they really looking to replicate what they do for the equity market and offer the same type of service to digital? Are you looking to retrofit crypto and digital into a traditional model? Will that work? Does that fit? Is that essentially the approach? Or are we looking at a completely new business model and a new approach to provide these types of services? And I'll ask that to you, Sven.
That is a short question. Probably will take me 3 hours to answer, but I would say it's a little bit of both. The truth is, it depends on the time period. I think initially you would see you're trying to retrofit, but ultimately to really take the advantage, and this is maybe less a question of crypto, but more about tokenized securities more broadly. We will need to evolve also the business models to really reap the benefits. So you need to move from centralization to decentralization, which means I need to be more open, transparent. We will have shared back offices, and that requires a rethink of almost everything you do. So I would say over time, a successful adoption requires also a rejigging a little bit of the value proposition traditional players represent.
Yeah, I just look, and sorry, Tana, just to finish off on that, there are people out there think that this is an opportunity to do a complete transformation of the bank, not just essentially for crypto, but essentially, as you rightly say, tokenization and securitization. It's a new way of actually essentially providing finance. So I take your point, you're absolutely right. And I pass back to you, Tiana.
Great. Well, thank you so much. It was a pleasure to have all of our panelists join us today. Brian, Alan, Nadine, and Sven, thank you so much for sharing your insights. I think that we can all agree that the custodial space is evolving at pace now. And as the demand continues to grow for digital assets, the institutional grade infrastructure becomes even more important. So with that, I would like to welcome our next guests, who I believe are going to dive just a bit deeper into some of the challenges and opportunities within digital asset custody today. It's my pleasure to welcome Asen, I'm going to murder your last name, Konstantinov, Head of Strategy at Copper, and Ryan Rugg, Head of America's Blockchain Service Team at IBM. Gentlemen, thank you so much for joining us today.
Thanks for having us.
Oh, sorry, Ryan, you're not a gentleman.
It's okay. With the name Ryan, I get it quite often.
And Asen?
Hi there.
Hi.
Pleasure to be here. Can I just ask the host to allow my video to be turned on? Thank you. It's a pleasure to be here. Thanks, Tiana.
Great to have you. I'll hand over to you, Asen. Take it away.
Thank you very much. And Ryan, great to be here to discuss this. I'm sure a very interesting topic for everyone. I guess let's start a bit at a high level, and address this question about how has the crypto custody space evolved over the past 3 years in your experience and the experience of IBM?
Yeah, thanks, Hassan. I appreciate it. So just a quick intro, Ryan Rugg, I've been with IBM since the beginning of the year. Prior to that, I worked in the fintech space for R3. So I've been in and around this space for around 5 years, worked with several large banks, as well as advisors on this. So, in the last 3 years, it's really evolved. I think we saw it move from retail, to now we're seeing much more institutional demand from it. And you can even think with COVID, that's been exacerbated in the sense with all this, fiscal policy and all these different, that the US government, as well as other governments have been doing, have created almost in the market, the perfect kind of, call it storm in regards to wanting to diversify. People are worried about deflationary dollars as well as other things. So looking for other store of value, you've seen more and more institutions, especially even recently, kind of move into this space, which is really fascinating to me. But I'll pass it back to you. Like, what are you seeing from Copper?
Yeah, it's actually fascinating the way the custody space has evolved, because probably 2018, 2019, most people were actually looking at cold storage when it came to custody. Literally bunkers buried somewhere in the Swiss mountains with physical guards with guns in front of them. That was to some extent the idea of ideal custody for digital assets, with, of course, everything being offline. That is definitely not conducive to trading and quick access. But since then, as you alluded to, due to especially in the past sort of year and a half, as we've seen institutions kind of flock to the space, definitely the offerings can become much more sophisticated, and there is demand for more sophisticated offerings. Of course, you need to now offer various speeds in terms of access to custody. In a lot of cases, people demand direct connections to liquidity venues. There is a lot of thinking about what are the policy engines that we need to apply to provide for different access. And then all sorts of integrated capabilities that can range from sort of somewhat traditional financial services capabilities, such as lending and execution, to more crypto native ones, such as staking or connectors to the DeFi ecosystem. So we've seen really the space explode, and I think all of the a lot of the providers have really upped their game during that time frame.
No, I agree. I mean, the whole cold wallet storage thing, buy and hold permanent, with asset managers and hedge funds coming in, they require much more sophisticated kind of, platforms to be able to hold their crypto. So it's definitely been an evolution. And, it's been incredible for me being in this space for, 5 years to see how the technology has evolved. We think back to, Mt. Gox and all that, the major hacks that happen in the market. And like, there's still, don't get me wrong, there's still risks, right? With, hot wallets and that and cybersecurity. And that's a big focus at, here at IBM about trying to help enhance, custody solutions of our partners that we partner with, because there are still risks out there, but you've seen the number of penetrations go down, and it's due to like the advancements in the technology, which is positive, albeit they're still there. And there has to be some considerations that, you need to weigh out when you're going through kind of your evaluation process.
Yeah, absolutely. And from your from where you sit, how have the banks reacted to all of this? Obviously, we saw last year the OCC kind of formally allowed them to offer custody services for crypto assets. That move has been somewhat controversial, but have you seen higher appetite from banks to get into the custody space within crypto?
Absolutely. And you've seen the evolution in this space. Most of the large banks have digital asset groups now. Digital assets encompasses a broad, from everything from cryptos to stable coins to CBDC and so forth. So it's a wide kind of arena in there, but they've started building out teams, they're publishing papers, they're experimenting with that. So it's been really positive. And I think a lot of that was, OCC did give the guardrails, as I like to call it, right? It's like, Sven mentioned before, it's like a lot of the regulators haven't said, don't do it, but they haven't said do it, which just provides uncertainty. And like no one, wants to lose their job over something. So, here in the US, we have, one of IBM subsidiaries, Promontory, they worked with the state of Wyoming. They've worked with several other large banks on engagements in there, really helping to set up the risk and compliance frameworks. And like, that's the guidance and like helping to interpret, OCC letter 1174 and what does it really mean? And can I, custodian, can I set up networks? What does it mean for long-term? And, it's the administration in the US is really interesting. We, I would say, have a more friendly or more aware, group of, policymakers than we've had in the past. And, Powell's supposed to publish a paper this month or next month with more insight. And there's, a working group in DC. So more to come there, but it's definitely given what I like to call the guardrails. Banks are feeling more comfortable to at least start investigating this space and, see, is it traditional rails or are they building up, all new rails? And is it, where, Nadine made a point about equities and trading versus custodian and like, how do you separate it and what you do, and rethinking the model where, most of them are on the journey at some point, but different points on it.
Yeah, absolutely. One other factor which I think should not be underestimated is, as we alluded to, the fact that institutions really came into the space gave a clear signal to some of the banks that this is a space that's here to stay, and that unless they move in now, then they're at risk of sort of missing the wave, so to say. Not to mention the fact that when you have some of the biggest Wall Street firms as your clients, and they're paying you millions in fees every year, when they knock on your door and ask what services can you provide for crypto, then the answer nothing is probably not the best one that you can give. So I think that has also sort of made them act quicker in the past sort of 6 to 12 months. And linked to that, so when we think about institutions coming in, can you give sort of a view as to how has that changed over the past 12 to 18 months? What type of institutions are you seeing coming into the space?
We're seeing much more sophisticated institutions, and it's really a range of what they want to do. Everything from NFTs to, you know, we're working with several of the, you know, large central banks about CBDC and, you know, interoperability between the various ones and how to scale and atomic settlement and, you know, to even like enterprises where, you know, we've seen it putting more and more digital assets onto their treasury balance sheet, which is really interesting as, you know, a store of value. And then you see large online payment providers that we've worked with in the past also that are making investments and starting to scale their business there for, you know, various, you know, you can trade on some of these online payment providers platform too, which is, you know, an evolution, right? It's like, are they becoming a one-stop shop and like, what's the path? And, you know, we help clients evaluate buy, build, partners, what I like to call it. Do you want to partner with a custodial provider? Do you want to potentially buy one? Do you want to build it out yourself? And there's different, you know, kind of, I would say, risks and, you know, through all of them, as well as costs, you know, so it's really kind of depends on each client and what their kind of, you know, risk appetite is, but also their like long-term vision. You know, if it's just near-term buy and hold, it's different than if they want to trade it and get to DeFi and, you know, potentially do their own tokens and so forth. But clients have become much more mature in this space in the last, you know, couple of years, which is really impressive.
Yeah, absolutely. I mean, that's definitely a trend we've observed as well. You know, 2-3 years ago, most of the sort of players or institutions were crypto native funds looking for custody or transitioning from self-custody into some sort of institutional custody, maybe traditional folks that were coming into the space trying to raise funds, you know, maybe the odd crypto business that was also looking for, you know, where to park their treasury. And since the beginning of 2020, really the space has exploded. And as you alluded to, all sorts of actors are actually coming and looking for services. And so when you're thinking about assessing a custodian, what are the primary considerations that you consider sort of most important?
Well, it really depends on the client's needs, right? You know, it's, you know, exchanges, you know, it depends on their behavior also. Are they going to be buy and hold? Are they going to trade? What is like, again, what is their roadmap in the future? And like, you know, they're also security from, you know, we work together with on the HyperProtect, you know, secure enclaves with keys. And it's like, really what is, you know, kind of their roadmap and their journey. So, like, you know, we all know like, exchanges are probably the least secure of them all, right? Where offline wallets are the most secure, right? Are the safest. But they're also, there goes, you know, it's difficult to trade from an offline wallet. It's slow and it's not, you know, and also you have to be willing to take all the onerous on yourself that if you lose those keys, your assets are gone, right? Where exchanges and third-party custodians put other measures in there, two-factor authentication. And there's like, you know, there's in between, you know, there's partial custodians and then there's complete, you know, custodians that, well, I like to call it, between self and whatnot. So again, it really depends on the client and like what their behavior is going to be. And, you know, so a lot of clients start out with just like self custodian, like offline, like buying de minimis though, just to kind of get their feet in the water, go through the procurement process, make sure that, you know, the CISOs and all them they're not going to lose their job over that. And, you know, setting up an environment for that to then where the level of comfort when they want to make a bigger investment for either for, you know, payments or for store of value, depending what their kind of long-term game is, comes with a different evaluation process. And we've developed a matrix based on kind of the inputs from the client that basically comes out with recommendations on, you know, custodians we've worked with like you guys in the past.
Mm-hmm. Yeah, absolutely. And as I alluded to in the beginning, we've seen the requirements becoming more and more sophisticated. You know, it's not just a matter of having somewhere to park your assets. Security is very important. You know, what type of technology, you know, whether it's just multi-sig or are you using MPC, where the shards stored, how are they distributed, you know, all these things that I'm sure you're painfully aware of at IBM are coming into play. And the clients are now, they're able to differentiate between these technologies. It used to be 2 years ago when you were talking to them about this, they were still asking, what's blockchain or Bitcoin, whereas nowadays they're very, very attuned to the differences between the various offerings. But there, you mentioned actually something very interesting about exchanges and them providing custody. Do you actually think that this is a good model to build the market on? A full stack model of an exchange where it combines custody and trading and potentially margin funding, all sorts of other client related services.
So I have my personal opinions, but in regards to the way I advise clients is, again, there was a great report from Chainalysis out a couple of years ago or last year about how, exchanges are targets because they hold a large amount of keys, and they do have a high. Most of the mature ones have a hybrid kind of hot and cold matrix set up for them, but they are targets of cybersecurity hackers out there, and you have to be aware of that because they have the flow of funds, so frequently in and out. So there are, again, risks with that, and it depends on what you're looking to do. And typically, what we found is it usually ends up being a hybrid model where several of our clients diversify, but it's an interesting conversation, and it's almost like religion. It becomes a big debate in the market about that also, where, again, from a security, scalability, privacy, control standpoint is where we kind of advise from, not necessarily like, this is what you should do per se.
Mm-hmm. Yeah, absolutely. Well, interestingly, some of the more traditional institutions coming into the space have pointed to this being a major sort of stumbling block, because obviously the traditional market sort of structure is organized in a very different way, where trading is strictly segregated from custody, and even within custody, you can have different models that cater to different sort of risk appetites. And that full stack model on the exchange side definitely, and the need to pre-fund those accounts before you trade is definitely proving a stumbling block from some of the institutions that are coming with a traditional mindset from what we've seen.
Which makes sense though, right? I mean, there's commingling of assets that they actually have ownership of the keys. There's a lot of considerations you need to think about when you're using an exchange as a custodian. And, it goes back to the original maximalist of blockchain, relying on a third party, right? And it goes back, that whole kind of thought process. So it's a big debate in the market, and I understand, why. And again, you just have to kind of evaluate the risks on each side of it and, see if it's right for your individual company to do that. But understanding eyes wide open, like, from a cybersecurity, from a commingling, from a private key aspect, giving up ownership, what it means for you and your organization.
Mm-hmm. Yeah, absolutely agree with that. We're almost at time. I guess time flies when you're so let's close off with sort of a kind of a question looking to the future. What do you think are how does the crypto custody landscape evolve in the next 3 years' time? What are your expectations?
Wow. I expect like a lot more institutional kind of players to come into this space and the technology to evolve. I've only been at IBM 9 months, and just in the last 9 months, watching how fast the pace of technology is moving because of demand. And, we're going to launch a custody challenge with inviting the ecosystem like Copper to come partner with our digital asset team, from a X-Force hacking team to cloud to security to risk and compliance, because I truly believe this technology is going to start scaling the next 6 to 18 months. And I left a startup and joined a large company to come here and do that. I wanted the resources to be able to help enable people because I believe in this technology and believe it's here to stay. For multiple reasons, for Sora Valley, as I mentioned, but also in the payment space, as well as, stablecoin and CBDC. I just see so much opportunity here. I'm really kind of excited to see what's coming forward. And I see, I think we're getting cut off, Hassan. I see.
Yeah, I mean, definitely just to say from my perspective, I think really a lot will depend on where the regulation goes. And of course, when it comes to the capital market space within digital assets, what we are really seeing is, as the more professional players come into the space with more institutional attitude, they're definitely looking for some of the segregation of duties that occurs in the traditional space. So therefore, people specializing in custody, segregating that from trading, I think will be the general direction of travel for the next 3-4 years, especially coupled with the sort of increased regulators' scrutiny into the space. Thanks very much. Over to you.
Yeah, no, I didn't mean to cut you off, Ryan. Definitely, if you have some closing remarks that you'd like to share, please.
No, I agree with Hassan. Like all eyes are on regulatory regimes, globally right now about what's going to happen in this space, because, as I mentioned earlier, it gives them what they consider guardrails, what they can do, how they can operate. A lot of these large institutions don't want to implement and start scaling a business just for regulators to come back and say that, they're in breach of, this regulation or that regulation. But more to come, the travel rules out there. There's a lot of new kind of regs coming out globally that'll be really interesting. And, I'm sure it'll be a fun ride with volatility coming in the near future.
Fantastic. Well, thank you both so much, Ryan, Hassan, for joining us. Fantastic discussion. And it was great to have you.
Great to be here.
So thank you so much to the audience for joining us today, and a special thanks to our sponsor, Copper, and all of our fantastic speakers. We have many more events coming up this year, so please do register for future invitations at parallelsummit.io or follow us on Twitter at Digital Chamber. The Chamber would also like to invite you to join our annual DC Blockchain Policy Conference, which will take place on the 24th of May, 2022 in Washington, DC. The summit will feature discussions with innovators and technologists from around the globe, include in-depth conversations with policymakers and regulators on the issues impacting the ever-growing blockchain landscape, custody being one of them, and we would absolutely love to see you there. So please do go to the Digital Chamber website and get more information. So we will see you next time. Until then.